Hi, today we're going to talk to you guys a little bit about reputational risk management. My name is Luke Dellinger.
I'm Lauren Kinder.
I'm Scott Turner.
I'm Eric Roth. And I'm Ryan Thurmer.
Today we're going to start off with a little bit of background introduction about what reputational risk is and what reputational risk management is. Reputation is defined as the perceived understanding and opinion of an entity. The Federal Reserve System's Commercial Bank Examination Manual defines reputational risk as the potential that negative publicity regarding an institution's business practices, whether true or not, will cause a decline in the customer base, cost litigation, or revenue reductions. Reputational risk is perceived by the board of directors as the greatest type of risk that a company can face in the lifetime of a company. It has the potential to ruin a reputation of a company, causing the most loss to a company's market value. It is important to take a careful and honest approach in managing risk and assessing appropriate steps in order to deal with that risk.
Determinants of reputational risk. The reputation reality gap is when an organization's reputation exceeds its actual character. This gap can be widened or narrowed by the changing beliefs and expectations of its shareholders. Shifting expectations and beliefs of shareholders can affect the reputation gap. Quality of internal coordination. Poor coordination of decision-making between business units and functions increases the reputational risks.
How to assess reputational risk. Reputational risk is based on the effect that other risks can have on a company's reputation. So there's several factors that must be considered when assessing reputational risk. First of all, the level of inherent risk the company has, which they categorize as high, moderate, or low. People will look at things such as the company's marketing plans, financial statements, how the public company image looks, and the advertising campaigns they run, as well as just how risky a company's business is. If a company has a risk of an employee getting sliced in two, they'll have more risk than other companies just because of a horrific factor. The level of risk management. If a company has better risk management, it's going to have a better level of reputational risk management as a general rule, just because there's less factors that can happen that will not have a countermeasure already in place, meaning that they'll have better responses, reputation has less chance to get damaged. This also has a better chance of avoiding any catastrophic risks, which are the risks that can actually damage a very well-established reputation. The third factor is the movement of risk. This is whether a company's risk is increasing or decreasing. This tends to be lower if a company is an older company. Newer companies will generally not know all the risks they may be exposed to and might not have countermeasures in place for an event.
Why companies are more at risk now? Consumers have greater access to company information and reviews, which could affect their perceptions of the company. These are impacted by today's use of IT systems, the increased use of the internet and social media, and 24-hour news cycles.
Reputational risk and IT connection. Since 2005, the concept of reputation risk has expanded to include the impact of IT risks. IT failures leading to reputational damage can include data breaches, systems failures, and data loss. The true price of reputational harm is sometimes underestimated, and the economic value of a company's reputation declines an average of 21% as a result of an IT breach of customer data.
Reputational risk in the internet. The increased use of the internet and social media is seen as a major problem for many companies' reputational risk. The organization's involvement in social media is not a choice made by the organization, but for the organization, because it helps connect them to their consumers. Social media services are very popular among internet users, and by using these services, the company can ensure they are high among search ratings. And so whenever somebody's on a Google or Bing, they will be higher on the list, and people are more likely to look at their company information and their links. And there is a saying that Google never forgets, so the internet never will forget that anything that's posted about the company, and anybody can access that negative information that might be posted. Digital publicity is defined as a complex combination consisting of mainstream media, social media, and search engines. It has created a blurred line between what is considered institutionalized and personal communication. Mass self-communication is defined as mass use of the internet and mobile communication to introduce information and debates not controlled by large media companies. This puts the reputation of the companies more in the hands of the online public because they have a say in what is being put on the internet about any company when they make reviews or they just make comments on any articles that have been posted. Stakeholder groups are also using the internet to exchange information and opinions, and it is causing a difference in between what the company actually wants to get out and what they want to stay within the company. Reputations and reputational narratives are now a construction of collective mass self-communication because of the stakeholder groups and the online public having access to all this information. And the combination of users creating and using content has this effect on the internet. The 24-hour news cycle has a very large impact on reputational risk because information about the company can be posted within hours of it happening on the news and within minutes on the internet. Not all the information may have been collected before these articles or brief little postings have been put on the internet or on the news, which can cause speculation about what actually occurred, and that will cause consumers' minds to run with those ideas and create their own results and can ruin their reputations because what they actually think has happened may not have actually happened, and so the perceived reputation is worse than the actual reputation. And the company may not know of some events before they're reported because the events can be posted so quickly. The company may not know of some things that have happened before they are actually reach the public, and they may not have any way of controlling or getting their feedback into the information that is being provided. This ability to get news out fast could turn a small mistake into a highly publicized event due to the speculation and the leaking or lacking of information.
All right, now that we've gone over what reputational risk is and how to analyze it, we're going to go over the 5 steps of how to manage it. The first step is assess the reputation. Basically, this is what Eric talked about, and this is where you measure the public perception contextually, objectively, and quantitatively. The second step is to evaluate reality. Basically, you need to figure out, in the first step, you found out what the public thought you could do or would do, and then this is what you actually can achieve or will be able to achieve. And then the third step, sort of logical, you just have to close those gaps. You don't want, you want to minimize the amount of gap that you have between what they think you can achieve and what you can actually achieve. The fourth step is to monitor the changing beliefs and expectations. You just, after you figure out the first 3 steps, you just have to keep a constant eye on it and adjust accordingly. And then the 5th step, which is the most important step, is you have to put one person in charge of this. This can't be spread out over multiple divisions because the responsibility is just going to get lost in the cracks. So you have to put one person in charge, and they're going to be the main one responsible.
Alright, now we're going to go over several examples of how companies have battled the adversity of reputational risk and when the reputation has been ruined. The first example is SunTrust Bank scandal back in 2004. In 2004, the SunTrust Bank announced that due to an accounting error, the company had to restate its corporate earnings. They found out that the bank had overbooked the allowance for loan and lease losses and therefore underreported earnings. In the first 2 quarters, they underreported them by over $22 million. In the end, or actually in the process of this event, the company was able to step up and automatically have a press release and let all the stakeholders and shareholders know what was going on. They were able to manage this event, and And the organization's board and executives were proactive in addressing the issue quickly and taking the appropriate steps to fix the problem. And in the end, there's very little impact to the company's reputation as well as very little impact to their market share because of how they manage this reputational risk.
All right, we're gonna talk a little bit about the BP oil spill, and we're gonna start off with showing you a video.
This is only the second time John's been out fishing in a year. But since the Gulf oil spill, he's kept busy, driving the cleanup boats hired by oil company BP.
Yeah, we all worked in a different capacity for BP. I think they did a good job.
Locals here were furious against BP after the Deepwater Horizon accident. But now, in a radical turnaround, many are singing its praises. A 6-month moratorium placed on deepwater drilling after the spill would have had a knock-on effect on the local economy. BP's handouts covered those losses.
We haven't felt the complete effect from the moratorium because of the infusion of cash that we've received from BP.
This family-run restaurant is a poster child for BP's largesse. It got a big check for lost business, and the British firm got a big boost with this ad, which ran on TV nationwide.
BP had to step up, and I think they did.
For the 3 months following the oil spill, BP tripled its advertising budget, hammering in its message on TV, in papers, and on the internet. We will fix the mess we made.
When you went online and you searched for BP, you would get top ranking their information about how they're responding to the oil spill.
BP's multi-billion-dollar disbursement to hundreds of thousands of victims has also helped the company and the industry at large. This lawyer says other gas and oil companies have pressured BP to do right by the Gulf region for their sake.
It's been a public relations disaster for the oil and gas industry. I think that BP is probably getting a lot of pressure from its peers, the other oil and gas companies, to get this over with.
A year of crisis, communication, and compensation, and BP has seen the payoff. 70% of Americans now support offshore oil drilling again, just as many as before the Deepwater Horizon oil platform sank.
So most of you guys are probably pretty familiar with the BP oil spill. This was a pretty massive spill. It actually spilled over 200 million gallons of oil into the Gulf for a total of 87 days, which ended up making it the biggest oil spill in U.S. history. And over 16,000 total miles of coastline have been affected, including the coast of Texas, Louisiana, Mississippi, Alabama, and Florida. And even though the gushing well was capped in 2010, oil is still washing up on shores, which could cause long-term damage to the people living in the area. And one of the big factors that happened right off the bat as soon as it exploded was 11 people were killed in the explosion and 17 others were injured. And so as you saw in the video, BP did a pretty good job, or actually a really good job of managing the reputation throughout this whole disaster. They ended up just kind of paying out of pocket for a lot of it. They paid over $40 billion in fines, and then with an additional $16 billion due to the Clean Water Act. And as you can see in the video as well, they had paid a lot of the fishermen to go out and clean up, and they paid a lot of the local restaurants sort of just cash to keep their business up and going until they could renew their business strength within the local communities.
An example of a company that did not do a very good job recovering from a reputational risk crisis was Sony during the PlayStation Network crash of 2011. On April 6, 2011, Sony announced that its PlayStation Network, also known as PSN, had experienced a data breach, which released the personal information of 70 million of its customers. Sony waited 6 days to release this information, which, combined with the fact that PlayStation Network went offline for 24 days afterwards, caused enormous public outrage.
All right, and this is an article that Dr. Marlette Davis in class. It was about a supply chain disruption for Walmart. This happened in Bangladesh in November of 2012. It was a factory fire for one of their linen manufacturers, and it actually killed 112 people. The damaging part to Walmart's reputation was that one of Walmart's supply chain managers knew that the factory did not meet their safety standards, yet he still let them continue manufacturing linens and still continued to contract with the factory. And Walmart, they sort of just try to turn a blind eye to this whole deal, and they just distanced themselves from the situation, saying that they had no knowledge of this whatsoever, and that was sort of enough to safeguard their reputation. But this isn't an example of great reputation risk management. This is just kind of scraping by.
As we've shown you, there can be some severe consequences for damaging your company's reputation. Prevention methods are great, but they can also fail, and that has created the need for reputational risk insurance. Once an event occurs, there are two primary costs associated with fixing it. There are the immediate response costs, such as cleaning up the oil spill or fixing the data breach in your network. And then there are the harder to determine costs with brand damage, meaning once it's all done and the media coverage has subsided, if you experience any loss in business or any bad will towards your brand as a consequence of that. Reputational risk insurance generally covers only response costs, and its policies are written for specific named perils, or they can be also written for all risks at a higher price. Some of the specific named perils are data breaches, executive scandals, and product recalls. These policies are triggered by adverse media-based coverage of one of these perils, and this, while these policies do provide money to assist companies with fixing the damages, these policies are not an effective replacement for company crisis plans. In addition to just getting insurance for response costs, there is beginning to be a desire for additional coverage. Munich Re has begun offering reputational risk insurance plans for the financial losses associated with brand damage. And these policies currently have a $65.5 million limit. This policy would be triggered not by media coverage, but by a 10% drop in asset turnover after the named peril had occurred. The insurance policy would compensate the company by ensuring that its gross profit margins stayed at a pre-agreed percentage, meaning that as a result of the brand damage, if the company's revenue stream dropped, the insurance company would effectively boost their capital to maintain their profit margins. Such a policy is very expensive and has actually not been sold yet, so that's still just theoretical almost.
Current insurance policies. Most companies do not know how to handle reputational risk insurance, and currently only 5 companies have policies that they are now selling to companies: AIG, Aon, Chartis, Munich Re, and Alliance. AIG is now offering Reputation Guard, which will refer clients to a pair of crisis communication firms when PR problems arise. Aon and Chartis launched specific products aimed to helping companies protect and manage their reputations, as well as crisis response service to help minimize reputational damage and restore a company's image. Munich Re launched a product to cover financial losses from a reputational risk event that mainly targets business to consumer companies. Alliance released Alliance Reputation Protect that helps respond to a crisis incident and provide a risk assessment to see how the company is currently perceived by the media and the public. There's also another company that took a more industry-specific route, which is Willis Global Solutions Consulting Group. and they offer Hotel Reputation Protection 2.0, which is specifically geared towards the hotel industry.
So, in conclusion, we hope you all have learned from this presentation that reputational risk management is a very important topic to educate yourselves about, especially as everyone goes out and gets jobs in larger companies and even in smaller companies. Reputation is something you should always be aware of, and every company today should be looking into either getting policies or setting up a crisis team that we had talked about previously. Especially with the increase in companies putting data online and the availability of their company's sensitive information through backdoor leaks and things like that, it's growing in importance every day. So we hope you've learned a lot about reputational risk, and that's all we have for you today.